From an investment banker's perspective, 2016 is expected to be a bit of a bad news, good news story. I'm going to zip through a bit of a market overview, some of which Julie's already presented, and that's, if you like, the gloomy part. Then I'm going to talk about M&A, equity capital markets and debt capital markets, and the picture that I want to leave you with is this is the good part. There's actually strong activity and not always uniform, particularly in equity and debt capital markets, but good solid opportunities, good solid growth. So turning to a market snapshot, that's the ASX 100 against the US S&P over the last 5 years. Don't need to say too much about it. I'm sure you all know the story, except to say in Australia at least it's been a bit of a grind. The US, we are 1.5% down on where we were 5 years ago, while the US is 40% up. Now, why that is, I'll leave to real economists, but I suspect easy money and the Bernanke put has at least had something to do with American strength. Perhaps more relevantly in Australia is a look at sector performance. This is a breakdown of ASX sector performance over a couple of periods. Now, if you look at that third column, the year to date, you can see it's a sea of almost unrelieved red. Real estate is the sort of tiny sliver of good news. Hardly worth noticing. But look at the right-hand side, the performance to 12 months. There, the obvious messages Julie's already signalled. Energy, which is essentially oil and gas, is down 37.9%. Miserable. We all know why. Materials, which is essentially mining in our language, is down 32%. Financials, we're all aware of the stock market performance of the banks, is down 22%. But then you look at, there's a couple of shoots of green. Healthcare is up, industrials is up, and utilities is up. And that supports the thesis that the stock market, at least, buys the transition story, that Australia is transitioning from energy, oil and gas and mining to industrials and services. Julie's talked about the dollar, and I won't say anything more about it except this. It's obviously fallen consistently over the last 3 year snapshot. The particular relevance that I want to draw out here is that while that's not a be-all and end-all for foreign investors, because they have to measure future returns in lower Australian dollars as well, but the headline price of lower Australian dollars is pricking up interest in foreign investment. So that's certainly helpful for us. Let me turn now to debt capital markets, a quick snapshot, using the US high yield market as a proxy for global debt capital markets generally. This shows both volume of high yield new issue and the yield since this time 2 years ago. What you can see is that undeniably there's been very little issuance in the last few months. So markets are nervous, debt markets have slowed and yields have increased. You can see that yield figure spiking up. And we all know CDS spreads have widened as well. So that might tell you, debt capital markets are terribly gloomy. But it's not unrelieved gloom. The market does distinguish between different sectors. This slide compares the all sector high yield index with the energy and coal index, and then looks at what the all sector index minus energy and coal would look like. And what it tells you is that nobody's buying energy and coal debt, or if they are, they're extracting very high prices for it. But when you take out the energy and coal sector, yields drop considerably. So markets distinguish between sectors, and markets are available, open and available to sectors. Commodity prices, we all know about. This is gold, coal, gold, oil and iron ore for the last 3 years, and the iron ore and oil graphs tell you a lot about why Australian mining, why we need to transition out of oil and gas and mining into other sectors of the economy. Let me now turn quickly to the M&A outlook. And the first thing I guess you've got to look at is the macro trends. You'll hear more about these from, you've heard about them from Julian, you'll hear about them from Michael Blythe, but overall low interest rates, depreciating dollar, low inflation, low wage growth, an economy which seems to be transitioning reasonably well, continued growth prospects for Australia. So if you're sitting in Tokyo in an ex-growth Japan, you'd be looking at Australia and saying, what's not to like? And we are certainly seeing that. There is significant foreign interest in Australian M&A activity. The Chinese interest gets all the attention and is high profile. We all know we were recently involved in the sale of Pacific Hydro to State Power, but everybody knows about the Chinese investment or Chinese interest in Kidman, in poles and wires and other things. But don't forget the Japanese. Nippon has just acquired a big chunk of MLC Life from NAB, and Japan Post swooped down and grabbed Toll. And don't forget the Canadians. The Canadians are showing enormous faith in the Australian economy. The Asiano transaction at the moment has got Canadians on both sides, but the Canadian pension funds, CPPIB, Ontario Teachers, CDPQ, are very interested in Australian electricity assets, in ports and infrastructure generally. And I haven't mentioned here, but we see sovereign wealth funds from Qatar, Kuwait, all over the world are very interested in Australian assets. Turning to sector themes, the infrastructure theme bears that out, and there's a continued supply of assets, more governments joining in the sale queue. West Australia's now joined in. Who knows, one day Queensland might. I certainly won't speculate about that here. But it's not just governments, it's, there's private sector interest. Asiano is the great example. In financial institutions, there will be significant activity because banks are rebalancing portfolios to meet capital requirements. So NAB got out of the UK got out of Clydesdale and the MLC, and that's a trend we'll see more of. Oil and gas, the theme is rationalisation. Who knows whether the PE bid for Santos was real to start with or will come again. I'm not going to make a comment on that, but that and the Woodside bid for Oil Search, those sorts of transactions show, gloom always brings some activity. Renewables, greater clarity about government interest has helped interest in that sector, as the sale of Pacific Hydro shows. In media, the prospect of change of ownership laws will certainly bring significant transaction work this year. In agriculture, the interest in the Kidman properties, the recent Chinese and other interest in dairy, who can forget the Warrnambool sale, is significant. In mining, there's a real question about, the question there is, have we reached the bottom yet? Big miners, Anglo has just announced sales of coal assets. There will be other transactions there. Healthcare and education, driven by government reforms, and real estate, there'll be continued transactions. In equity capital markets, you might think it's all doom and gloom, and those stock market charts would not show you too much optimism. But I can assure you there is significant interest among super funds and investors. There's significant liquidity and interest in providing funds for growth projects. We find no difficulty in funding well-structured, good quality M&A projects, for example, with equity or debt. There's significant continued interest in, there's a lot of liquidity sloshing around in super funds and other investors, and they want to put it to work in growth projects. So for good quality acquisitions, we almost get knocked over in the rush. Balance sheet repair will be another theme this year. We've already seen some of it last year with the banks and with Santos, and there'll be more this year. So again, plenty of supply for the right project. IPOs, well, I put a question mark there because I don't know the answer. If anybody does, please let me know. Finally, to close on debt capital markets, debt capital markets are nervous, both in Australia and overseas. Issuance is down, as we've seen, but we certainly see some sectors are easily able to access all the debt they need. It's obviously difficult for others. I'm not going to predict where they're going to go. Clearly there's a bit of nervousness in those markets at the moment. It has been affected to some extent by, there's significant reduction in liquidity caused by government regulation in the last few years. Global investment banks, including mine, have significantly scaled back their fixed income departments, and that in turn significantly reduces liquidity levels in those markets. So that's not a positive. But overall, I guess the message I want to leave you with, particularly for the M&A market and for foreign investment in Australia, is a very positive one. Lots of opportunity.